Nizan Mosery. You know what we're here to talk about, right? No, you don't, because I'm throwing some hard questions at you. Play devil's advocate. We're going to talk real estate, and we're going to talk money-making machine. How does that all sound?
All right, man, let's go.
I knew you'd be the perfect one for this because you're a good thinker on your feet. You know what's going on. You know real estate. You've done a bunch of stuff. This is going to be perfect for you. You ready?
Right. Yeah, man.
All right, we're going to take 20 minutes to chat about something difficult to talk about. But let's say the end of the world as it relates to real estate. You know, people are talking about that. We've had a couple of clients actually just on Thursday. They were talking about, I don't want to invest in real estate. The end is coming forth. What are your thoughts on that? Let's debate a little bit.
It's the end of the world as we know it.
Oh, nice. Very nice.
I mean, you know what? It's for some people, it's the end of the world. For some people, it's the end of the world for their properties, some of their properties. For some, it's the beginning of a new era, the age of Aquarius, right?
Mm-hmm.
It all depends on how you bought and how you manage and what's going on. I mean, wholesalers, for example, real estate wholesalers, a lot of states, it's gonna become illegal to be a wholesaler unless you have a license.
Yeah.
Right.
Yeah,
so a lot of these guys who just want to start wholesaling, they're going to be out of a job.
Anyway, none of them are going to want to get certified, by the way.
Right.
Or registered.
No, they're not going to want to take the test. They're not going to do anything. Right. So for all you wholesalers out there listening, when you're ready to jump ship and come onto the multifamily game, come talk to me. I'll educate you on multifamily so you can really make some money.
Well, that was good. That was very good.
But markets shift, man. Markets shift. Things move. You got to be able to flow with the go and go with the flow.
Mm-hmm.
And it's all about being conservative. It's all about being able to see 20 steps ahead of you. I mean, shit, even the big boys like Blackstone, they had to sell a $400 million portfolio for $140 million because they knew they were gonna eat dirt on it. So they dropped it. They sold it. I mean, nobody's bitching to them, right? So it's the end for some, and it's the end for a lot. And let's see what happens. It's going to be interesting. But I do think that with the change in power, and I do think Trump will be elected.
Look at you! You know that for a fact, huh?
I listen. I don't know anything for a fact, man. If I knew things for a fact, I'd be on my catamaran right now, floating in the ocean.
Which I'm surprised you're not right now, but yeah.
But I do think that he will be elected if it's a fair election, and you don't get all these illegal immigrants voting and whatnot. I think he will be the next president, and I think he's going to help inflation and help interest rates, and there may be a new shift, a new paradigm shift, and we'll see what happens. But I know a lot of people are holding to their guns until November 6th to see what goes on.
I think people are really afraid now more than ever. I think maybe not more than ever, but people are afraid. People are thinking, well, who knows if we're heading towards the edge of the cliff or not. But what I would say is, buy low, sell high. People do the exact opposite. They only really like buying at the top and then selling at the bottom. But I don't know if there's if we have a crisis coming in front of us or not. But what I would say is, at least. There's some very smart people who are getting pretty concerned about what's going on in the commercial real estate space, and also multifamily. That's the reason I mentioned that, and I think it's worth noting. And that's why you could talk. You're very good at talking. That's the reason I wanted to bring it up to you.
Yeah, no, sure. Again, look, in what are we 24 now? So 2021, 2022, even in 2020, people were buying at 3 caps with a 3-year bridge loan. So think about it. 2021, you bought at a 3 cap. With a 3-year bridge loan, your note is coming due this year.
Exactly right.
And your 3 cap is now a 5, 6, or 7 cap, which means you're SOL, buddy. All your investors are SOL. The best that you can do is maybe sell it for what you owe on it, right? Because that's a lot of equity that you're going to have to raise from your investors. I was looking at people, and don't get me wrong, there were people that were making a crap ton of money at that time. They were buying a 3 cap, then they were flipping it, made 4 million, 5 million, a million within 12 months, 20 months. I'm the kind of guy that I was sitting in the back seats. I was sitting in the bleachers, and I was just watching that happen. I'm a conservative guy, right? When people are greedy, be fearful, right? I was scared as AF, right? I was not buying. I did not want to go into that world where I was buying, low cap rates, preying on that appreciation, finding a right buyer at the time and selling. It's just too stressful. Can you make money? Absolutely, but it all depends on the risks that you want to take and so forth. I'm the long play. I like to go in. I like to buy for a cash flow and appreciation, but it's got a cash flow, right? We're working on an 80-unit property right now. We're putting it up. We're probably going to put it under contract. We're the only people that the seller's negotiating with, and it's a $4 million seller finance. He's financing us $4 million out of the $6 million. So we're going to raise about $2.5 million. But the beauty of it is that the cash flows day one, 100% occupied. It's got a wait list. And 30 miles north of it, Ford Motors is building their largest motor plant in the history of Ford Motors, $5.6 billion. They're going to bring 66,000 jobs to that market.
Yeah, that's a smart deal right there. I like that. That's the skeleton of a good deal.
Yeah, all day, every day, and that's the long play. Yeah, it's going to cash flow now, but in 2 years, when that plant is finished and those jobs start coming, and if you know anything about the motor companies, it's like they're like Walmart. Right? Walmart wants to have everybody who has product on their shelves in Northwest Arkansas, headquarters, right there, an hour away, less than an hour away. Motor companies need to have their vendors less than 24 hours away so they can get product to the plant, to the factory show floor within 24 hours. So guess what? Glass companies, plastic companies, electronics, all those guys are going to have to open up within a 24-hour drive. And if I'm 30 miles south, guess what? And they're already building the glass plant. They're building hospitals, infrastructure, all of that. So that's what you got to look for.
That's pretty smart. That's smart. That's why you're one of the gurus of real estate in multifamily space. Ideas like that, and that's probably what's protected you from, if we are heading towards an abyss as far as the investment markets go.
Yeah, that's right. It's all about the job growth, man. You want to go into a place that's got a lot of job growth. I was talking about that on my coaching call today. We were talking about market research. A lot of people go in and they look at where are people moving to. But in today's world, that doesn't mean job growth. That just means population expansion, meaning that people with laptops and with cell phones who can work remotely, they can go live there, but they're not creating new jobs. So, yes, you want to look at a place where people are moving to, but you want to look at where are the jobs being created? What kind of jobs? Are they service-oriented jobs, permanent jobs, temporary jobs? Is it a job that feeds into another community that expands, vendors and so forth? That's what you want to look for.
Is that your theme? Is that what you're doing on the conservative side as far as multifamily? I mean, going to where the jobs are, and there's going to be a need for an apartment building, et cetera, et cetera. That's the overriding theme for your deal?
Absolutely, man. That's the only place to go. That's the only metric that we look at, right? I mean, it's not the only metric, but that's that's what I call the Holy Grail.
Yeah, I get it. Well, what about the downside? Because you mentioned, people buying it, low cap rates, then all of a sudden getting worse because, people can't get refi or whatever. How are you affected by that? Again, I'm looking for something.
How am I affected by that?
Yeah. How are your deals affected by that?
My deals, thank God my deals are doing well. They're not being affected by it because we bought at a decent cap rate. The last 3 properties that I acquired were Class A student housing properties. Okay. I'll give you an example. The last property we bought was a 1-year-old property. 1-year-old, was built in 2023.
Okay.
We bought that at a 5.5 cap rate.
Okay.
Our exit strategy is to sell at a 6 cap rate. So we're going even on a more conservative. And we're saying in 5 years from now, a Class A brand new product is still brand new. All the warranties are there. Everything is listed there. There's no, your repairs are minimal because everything is new. And the increase in rents, and especially with student housing, which is a niche in multifamily, we're going to tier 1 universities. We're going to universities where they're growing. where the student body is growing, where they don't have room to house all the freshmen and sophomores. You know, I live in Boca Raton, Florida. We have FAU. FAU a couple of years ago, and there's a perfect example. FAU a couple of years ago, the football team went to the finals, Final Four. Since then, the school has exploded in applications for students. My daughter wants to go to FAU. There were like 50, 60,000 applicants. They're housing the students in hotels because there's not enough student housing. There's another university called Lynn University, which is a very small university, 3,000 students, private school, great school. A company, a group is coming into Boca building a 400-unit complex student housing because there's no demand, because there are no places to put them. There's such high demand. So when you look at these factors, so, you know, I bought a brand new property at a 5.5 cap rate. I could still sell it in 5 years at a 5 cap or 5.5 cap rate. But we projected it to be conservative, and we increased that cap rate by 50 bips. And we said, what happens if we sell it at a 6 cap? And when we do our offering to our investors, we give them, you know, we do like a stress test. We put on the offering memorandum. What happens if we have to, okay, our goal is to sell it in year 5 at a 6 cap. What happens if we sell it at a 7 cap in year 5? Are you still making money? Yeah, you're still making money. What happens if we sell it in year 3 at a 4 cap? What happens if we sell it in year 3 at a 6 cap? So we give them the stress test, so they look at it and they go, you know what? If worst case scenario, we have to hold it 6, 7 years and we have to sell it at a high cap rate, we're still making money on the property. So it's a good opportunity, right?
All right. So it's called the Flutie effect, by the way, we were talking about.
Exactly. The Doug Flutie effect.
All right. So, okay. So let's talk a little bit about the kind of specifics of how you put together a deal. We do have some real estate agents, a lot of real estate investors are going to be watching and listening to this. So, and they might be interested how you put together each deal. I know there's, you know, no one size fits all, but just in general, how do you put together your deals? One LLC,
there's
how many investors,
LLC,
you know what I mean?
Yeah, there's an LLC that takes ownership of the company, of the property. And then in that you have your Class A investors, which are the equity investors, our LPs, our limited partners, and they have a limited liability. So the, you know, lenders, anybody, you know, creditors, don't go after them. They have a limited say in the day-to-day, and that's why we do a syndication, right? SEC rules and regulations. And then depending on if we're bringing on an institutional JV equity group, call it whatever you want, institutional equity, JV equity, whatever you want, they will usually decide and say, you know what, we want another entity for us underneath that umbrella, or we want 2 other entities. So they'll also make those decisions on how they want the managers listed. Maybe it's a separate LLC under that main LLC. So we do all that. We have our SEC attorneys that take care of all that. They create the legal documents, the private placement memorandums, and the subscription booklets, and all that, and the operating agreements. And then, so what we look for is we look to give our investors. Now, every deal it's a deal by deal basis, right? But on average, let's say, right, if you took all of our assets, on average, we look to pay out anywhere between 7 to 8% from cash flow. That's kind of industry standard, you know. We do that, waterfalls and all that kind of stuff. And on the back end, when we sell, our goal is for it to be anywhere between a 17 to 18% IRR minimum. Because if you know Einstein's rule of 72 and all that kind of stuff, right? That gives that in 5 years, you'll double your money. So that's our goal. That's what we look at, right? We want to make sure that our investors within a 5-year hold, at least in a 5-year hold, will double their money, right? And we'll go out. And that's kind of what we look for. And a lot of times, not a lot of times, but some of the times when we're doing a great property, the property is fantastic, right? Like the Class A, where the price is a little bit high. You know, what we'll do as the GP, we'll front the cash flow. When I say front, meaning we won't take cash flow ourselves. We'll pass all that cash flow to the investors, right, until they make their returns and so forth. And that could be all the way till the time when we sell the property. So the GP won't be eating during the cash flow because we're going to give it all to the investors. Right. And then we'll hold it for, you know, anywhere 3 to 5 years, and we'll sell it. We bought a student housing property in Murfreesboro, Tennessee, literally 0.1 miles, like 1/10 of a mile away from the university. We bought it last year. We leased up now for this school year. Now we're going to start leasing up. We're gonna create the leasing for next school year. I had somebody just reach out to me today, ask him if you want to sell it.
Okay, so I want to play devil's advocate. I'm in the mood. What about people who say, don't do apartment buildings, college apartment buildings, because man, those college kids will wreck the property. What do you say about that?
I tell them to stop watching Animal House.
Yeah. Apparently you didn't go to the same college as I did. Yeah, I think I know what you're saying. I know what you're saying.
But look, but a lot of those things are look, the kids that we have, right? They're at tier 1 universities. They're on scholarships. A lot of these kids, and we pick the schools that have in-state scholarships: UGA, Georgia Tech, University, Georgia College, all the Florida State universities, the Tennessee State universities, Arkansas State universities, right? These universities have in-state scholarships, and a majority of the students in these universities go in-state. So what does that mean? That they have scholarships. If they screw up, guess what? Their scholarship is gone, right? A lot of them are athletes as well. So they're on athletic scholarships. They're on scholastic scholarships. And what's beautiful about it also is that the parents are guarantors on the leases.
Do you always make that? I didn't know that was the case. You always make that the case? Oh,
we make that on a majority of the places. Now, obviously, if there's a student that is, he's a senior and he's got a job and he's got good income and whatnot, blah, blah, we may not hold the parents liable. But freshmen, sophomores, yeah, you know what? We get the parents on the hook, and now they're guarantors. So, if you were in college and you put your head through the wall at a party, or your friends did, you'll be getting a call from us going, Mr. French, we love your kids. They're awesome people. They had a great party last night. One of their friends put their head through the wall. We'll send you the bill.
Yeah, I gotcha. I hear where you're coming from. All right, then what about the thought that there's 3 months where you're not getting income because it's summertime?
It's 12-month leases, my friend.
Wow, look at you. You're a hard guy to debate again. I like that. I hear what you're saying. All right. So what about, give me a story where it has not worked out for a client or it has not worked out for a building. So now I'm asking for the downside.
On student housing?
Nah,
or whatever. Multifamily.
Multifamily, whichever the case.
I mean, look, I'm transparent, right? We have a property that we bought with a floating rate because we didn't think that the interest rates would go so freaking high as they did. And I'll never do that again. You make mistakes once. And right now, and what happened, and that market is a strong market, but what happened now is these new Class A properties that came that they just finished building, they dropped their prices so low to fill it all up. Everybody's going to them. Now, now we're waiting for them to stabilize and then for them to start raising rents again so that we can start pushing our rents, right? So our rents are as max as we can, and now we got to come due on our bridge note. So now we're going in and we're doing a capital call.
Got it. So that's one of the downsides. Every once in a while that'll pop up, huh?
Right, but you learn from your mistakes. You never do a variable rate, and if you're gonna do a variable rate, you buy a rate cap.
Yeah,
so that rate can never go up, can never go higher than X, right?
So you're shielded from your downsides. What you're saying as a result of that.
Right, and you want to do you really want to do your conservative numbers rolling in, but listen, we also tell the investors, look, we can sell now, and we get out of the deal, or you come up with more money and we save the deal, because now what we can do is we can refinance. We refinance into a lower interest rate. Yeah, we got to come out of pocket a little bit more, right, to get that new money in, but now the property is going to cash flow, and now we can hold it for another 5 years. Cycles, things will always come back, and then we'll be able to sell it down the road and recoup our money. It's all about keeping the equity. It's all about keeping your money safe. And the way you keep the money safe is by keeping the property safe.
Yeah. And partially the reason I asked about on the downside, because I know you well enough. I know you're one of those thinkers that can think through a process and, try to get out of trouble. That's the reason I asked about that. So on the flip side, that obviously it's worked out you've been in the industry for a while. So it's worked out. So let's hear a little bit about your background so people understand, like, you're not the perfect looking guy that you are. You used to have a big ponytail, Rastafarian or whatever. Go ahead and
that's right.
I think that's a crazy cool story. Go ahead and mention that.
Yeah, so I'm first generation American, born and raised in New York City. My family's from Israel. At the age of 25, my father passed away, and I started drinking, doing drugs, doing all that crazy stuff because I lost the meaning of life. I didn't understand what life was all about. So then I packed up my bags. I worked on Lehman Brothers as a cold caller for many years. Didn't like that. Didn't want to pursue that. Then I went to Israel. Sat on the beach there for many years, for about a year. Watched the sun go up and down, up and down. And a friend of mine told me he was going to India. I'm like, you know what, dude? Never been to India. Sounds interesting. Everybody in Israel has been to India after the army. A lot of the soldiers, after they get released from the army, they'll either go to Southeast Asia or South America for a year trip, just kind of let it all out, come back, go into studies and work and whatnot.
Wait a minute, how old are you at this point?
I was 27.
Huh, okay.
I was 27.
Okay.
My friend had already been to India like 2 or 3 times. So I'm like,
Mhm.
dude, you know what? I'm going. I'm coming with you. I got nothing else to do. I got no responsibilities. I don't have a job. I don't have a mortgage. I don't have a family. I don't have kids. I'm like, I got nothing. I could sit and play with my belly button in Tel Aviv, or sitting on the beaches and go and play with my belly button.
Mm.
So we traveled for 2 months. He came back to Israel, and again, no responsibilities, nothing. And I continued traveling. I spent almost a year in India, traveling all over the place.
Mhm.
Grew my hair long, did all that kind of stuff, went the hippie route, and then continued traveling for about 7 years all over the world.
I didn't know that long. Are you serious? I knew you
Yeah,
traveled. I
man.
didn't know that long. Huh.
Yeah.
Okay.
I mean, and again, the only reason why I got serious and why I'm sitting here talking to you today is because I met this incredible woman in Portugal. She was from, her family's from Poland. She was born in Poland. She was raised in Germany. They left communism. I met her in Portugal at one of these music festivals, electronic music festivals, and it's funny because we didn't actually meet at the festival. We met after the festival in a campsite. I was driving from the campsite one day into town with my friend to see the sunset. We were in Portugal, so we could see the
Mm.
sunset. And as we're driving into the village, there was a rock, a big boulder about 50 yards off the road, and she was popping a squat behind the boulder. I'm like, dude, we got to meet these chicks. We
She's
got to meet
perfect
these
for
chicks.
me. Yeah.
I'm like, that's the kind of chick I want, right? One who can like pop a squat in the middle of nowhere, has no qualms about it, low maintenance. I'm like, that's the chick for me.
Only you, dude. Only you. Yeah, I
So,
got
so
you.
we met, we talked, this and that, we hung out. She went back to Germany, and she was on my mind the whole time, and I was sending her text messages, I was writing her poetry and all that kind of shit. And then one day I called her up. I'm like, hey, I'm coming to Germany. She goes, what do you mean you're coming? Where are you gonna stay? So I'm gonna crash out in your sofa. She goes, no. I live with my parents. I'm like, you live with your parents? I'm like, how old are you? She goes, no, that's custom in Europe. Like you live with your parents. She goes, I'm in graduate studies, art graduates, and all that. I said, all right, just get me a hotel somewhere downtown, wherever. So she got me a hotel. We hung out, and that was it, man. That's been 22 years now.
Yeah, obviously it's worked out. Seems like a sweetheart. I hear you. That's a good story. Yeah, that helps provide some color for your deal. So now wrapping a bow around everything. So we've already talked about the downside. Give us maybe a too rosy of a picture for someone who's just crushed it. Someone who's invested in one of your deals. They put in whatever the number is, 100,000, and now it's worth $1 million. Give us a good story. You know what I mean?
So a good story is I bought a 128 unit property in Greensboro, North Carolina. And I can give you the dates, September of 2019.
Okay.
Think about where we're going into September of 2019, right?
Totally. Yeah.
That's COVID times, right? We're starting the
Yeah.
COVID times. Now, again, real estate is about location and time, location in timing, location and time, right? Is it a good time to buy the property, right? On the market cycle. The sellers wanted to sell. It was a good location, physical location, because if you look at Greensboro, it had that loop, that outer loop, that the highway.
Oh, yep.
But on the north part of the city, they didn't finish that loop. So we bought it where that loop wasn't finished, but on the inside of the loop. So we're very close to downtown, and we had 2 exits that that were supposed to be built on either side of the property on that loop. And when we bought it, they were starting to build the infrastructure to close that loop.
Okay.
And beautiful property. It was one of my nicest properties. I really love that property. It was built in 2016. 2002, something like that. So it was still fairly new. It was good condition. We went in and we did, nothing major. We went in, we painted the cabinets, redid the countertops, put in the linoleum vinyl flooring, all that kind of stuff. And we were raising rents and we were pushing rents. And we went through several different property managers until we found the one woman, Deborah, who was a rock star. And delinquency was down even through COVID, people to pay and whatnot, and getting the right tenants in there, right? It's all about getting the right tenant, right? The person who's got the job, who's responsible, who's going to pay, who understands about their credit rating and all that kind of stuff. And we also went in there and we told the tenants on all of our properties, we said, if you pay on time, we're going to, how a lot of times people say, well, if you don't pay, I'm gonna ding your credit on a negative side.
Yeah.
We say, if you pay on time, we're going to ding your credit on the positive
side. Yeah.
We'll help you grow.
Yep.
So that was 2019. Come February of when was it? It was February of 2022. January, February of 22. This is when people, we're starting to get out of COVID, right? And this was when the buying frenzy, people were buying.
Yeah.
I got, and I'm getting calls from brokers. Hey, do you want to sell? Do you want to sell? Do you want to sell? I'm like, I can't sell. I got $1 million prepayment penalty if I sell now. I got a 7-year term. We're only in year 2. I got a call from a gentleman that I know. He sold the property. He had to do a 1031, and so we bought it for $9.8 million.
Oh wow! Okay, it was how many units?
128 units.
Okay.
We sold it March of 2022 for $16.5 million.
There you go, buddy. Yeah.
$16.5 million. That was one. We did another one years and years ago in Dallas.
By the way, you forgot to mention how much you put into it, but I'm going to assume you didn't put in that
like
much.
$500,000.
Yeah, so that totally worked out. I mean,
not much. We didn't put much into it,
Even if you made $3 million off it, which you made more than that. I mean, even that's a good rate of return. So yeah, had some happy clients in that.
Oh
case.
yeah, absolutely.
Yeah.
I think we don't hold me to the dollar. I think we raised like $2.5 million for it, right, for the equity. So we our investors made out like bandits. We did another deal before that one. It was 240 units in Dallas by the Love Airport. That was a C-class property. Blue collar, working class. We bought that for, I want to say, $6 million. We put about just under $1 million in the renovations, and then 2 years later, we sold that for $11 million.
Yeah. So again, even transaction costs, you still made a bunch of dough. I hear you. That's why you're a player. That's why you've made a big name for yourself.
I mean, look, think about it. Think about this. I'm sorry, but another one. So this Class A property that we bought, the student housing by UGA, we bought that for $21.5 million. We just increased 10% income from last year on average. Expenses stayed the same. Now, if you do the actual increase in numbers, we went from a $21 million acquisition purchase price. Now the property is worth $27 million. And that's in a year.
Yeah. I mean, let's talk about that. I mean, remember, most of our investors are pretty senior, but some might not understand for multifamily kind of the value of rents and raising rents. I think that's what you're good at. So go into that a little bit, because I think what you're doing, let's say you're raising a rent, making up a number, from $1,000 to $1,250 a month.
Let's say, So let's just say you're raising rent. Let's say you've got a 150 unit property, right? Okay. And you're raising rents by $200 a month. All right.
Per unit. Okay.
Yeah, per unit. That's $30,000 on income. Now remember, your expenses don't go up just because you're raising rents. Your expenses don't go up. That's $30,000, and you multiply that by 12. That's $360,000. Okay?
And you're going into places that usually need a little bit of lipstick to fix them up, and you can usually put in raise the rents astronomically relative to the expense. Yeah. Okay.
Correct. Right. So now that's $360,000 that you just increased the rent. Your NOI, your net operating income, right? Now, let's say on a conservative basis, you bought that at an 8% capitalization rate, right? That shows you how much money you're going to make on your money. So let's take your NOI and let's divide that by 8%.
NOI, net operating income. Okay.
Right. You divide that by the 8% capitalization rate. You just raised the value of your property by $4.5 million.
Yeah. So, I mean, think about how smart that is for the listeners and viewers out there. Basically, what you're doing is you're buying, let's say, an underappreciated asset, hopefully in a pretty nice area where all you have to do is put in a little bit of work, raise the rent, therefore the value of the overall property increases that much more. Then
right.
What does that allow you? You can, well, I'll open it up to you. What does that allow you now that you've been able to do that?
Oh, it allows you. I mean, that raising rents, it allows you to go out and sell the property.
All right, sell the
Allows you to
property,
go out
or
and
you
make
can
money.
get a loan against it, or I mean,
You can do whatever you
leverage
want,
it
right?
up. Yeah,
That's right. Let's take that Tennessee property by the Ford Motor Plant that we're putting on the contract. That's 80 units, right? The broker told us right now that you can easily push rents without doing anything to it, about $150 without doing it. Now, forget about the Ford Motor Plant that's going to come in and the renovations that we're going to do to the property. But let's take 80 units times, and let's just go conservative, $100, not even 150, but $100, right? That's $8,000 a month times 12 months. That's $96,000 of increased net operating income that you just increased the value of the property, right? And we're going to divide that by, we're buying it at a 6 cap rate, right? So you divide that by 6%. So we just raised the property value by $1.6 million. Now, so take that $1.6 million and divide that by the $2.6 million of equity that we're raising. So you just made a 61% increase in your return by doing that.
Yeah. And so, okay, then I'm in a combative mood or whatever you want to call it. So why wouldn't I want to, why would I want to go to multifamily when I can do a fix and flip? Let's say I want to do an apartment building and try to fix it and flip it within a year or two. I'm just trying to play devil's advocate.
No. That's great because there's this thing. Now you can do that, but what happens when you start doing that, the IRS tags you as a dealer.
True. Yeah.
Okay. And when you're a dealer, you're paying the highest level of taxes.
Yep.
Right. There's no way to get around it. Now, when you're buying, you're holding for a long period of time, right? What we do when we acquire a property on day 2, we hire a cost segregation company. It's called Engineered Tax Services, and they're out of West Palm. I know the owner. We love them. We've been doing business with them. They come in, they do the engineering report. They send that to our CPA, and now we get what's called bonus depreciation or accelerated depreciation. And we can do that, and we can take that in year 1. We can take it in year 2. That now we pass it off to our investors, and anyone who's making passive income. Now, I'm not a CPA, right? Let's make that disclaimer, right? I only play one on television on the weekend.
Yeah, I get you. Yeah.
Right. But we pass that depreciation on to our investors so that they can put it against their passive income and reduce their tax liability. Right. Yeah. When you do that, now you can get that. And then after year 1 or 2, you still have the depreciation of the asset itself that you can take going over the years. On top of that, you're getting cash flow. You're getting appreciation. You're doing all of that where when you're flipping, you can flip a single family house, which I've done. I flipped also multifamily, which I've done, right? Guess what? As soon as you sell that property, what do you got?
Yeah, you have nothing. I think fix and flips. I mean, what invariably will happen is you'll go into a downturn, and then you'll have a property that you can't do anything with. You can't sell it, and that was the intent when you bought it. I think that's an issue. I think what you're right. You're totally right about the tax issue. Plus, I think rents in general are always going to go up. It's not that much. It's not that. I know it sounds bad. It's not that much work to fix up a building, especially when you're buying it from someone who's as I call him, as Dolph DeRoos calls it, a don't wanter. You know what I mean? And so they're not doing a good job of the rent. So now what can you do? You can raise the rents, et cetera, et cetera. I think everything you said makes a lot of sense. You just got
to buy conservatively. If you can buy conservatively and it can cash flow day 1, you're gold.
Yeah. So let's start. Let's get ready to close the door on this. First, how does someone get a hold of you if they're interested in learning, maybe being coached by you or investing in your gig?
Yeah, man. Awesome. Thank you. So, feel free to call me or text me 561-212-7247, or you can reach me by email. My first name, Nizan, Nizan, at mtninvestmentgroup.com. And you can check out my my investment website. That's mtninvestmentgroup.com. Or you can go to my coaching site. That's multifamilyinc.com. That's multifamilyinc.com. and
And
check
you're
me out
working
over
with
there.
people all over the country, coaching candidates, or
Yep.
sorry, yeah, potentially to be coaching candidates, and also who knows, maybe an investor. It could be anyone in the U.S., any state, correct?
Absolutely. Absolutely. My goal is to help people achieve financial freedom, time freedom, so that they can go out and do what they're passionate about and leave this world a better place than what we found it.
Yeah, dude, you're a good dude. I trust. I mean, I believe you. And a lot of my deals, I like to only work with people with whom I enjoy spending time. And you're one of those guys. I know you're one of
Yeah,
those
man.
guys who, you walk the talk. You know exactly what's going on.
I
I really
appreciate
appreciate
that,
you.
brother.
I really appreciate you. For everyone out there watching and listening, I really appreciate you taking the time to watch and listen to this. Once again, this is Kenner French with Vast Voice, telling business secrets to entrepreneurs. Thanks, everybody.